Capital gains tax is something many Americans hear about, especially when they sell stocks, real estate, or other valuable items. But what does it really mean? In simple words, capital gains tax is the tax you pay on the profit you make when you sell something for more than you paid for it. Whether you're an investor, homeowner, or someone just starting to trade, understanding capital gains tax helps you plan better and avoid surprises. This guide breaks down everything in clear, simple steps, so you'll feel more confident about how capital gains work and what rules apply in 2025. In this video, we will talk about understanding capital gains tax in the U.S. So before we get started, make sure to hit the like button and also subscribe to our channel. 1. What are capital gains? A capital gain happens when you sell an asset, like a stock, bond, property, or crypto, for more than you bought it. For example, if you buy a stock for $500 and sell it later for $800, your capital gain is $300. This gain is considered income and is taxed differently than your job wages. But you don't pay the tax until you actually sell the item and make a profit. Not all assets create capital gains. Some items, like cars or clothes, lose value. But when they increase in value and you sell them, that's when the IRS gets involved. 2. Short-term versus long-term capital gains. There are two types of capital gains, short-term and long-term. If you own an asset for 1 year or less before selling, it's short-term. If you hold it for more than 1 year, it's long-term. Short-term gains are taxed just like regular income, at your usual tax rate. That can be high if you earn a lot. Long-term gains, however, are taxed at lower special rates. To save on taxes, many people try to hold investments longer than 1 year. Just by waiting, you could pay much less tax on the same gain. 3. What are capital losses? Sometimes you sell something for less than you paid. That's a capital loss. For example, if you buy stock for $1,000 and sell it for $700, you lose $300. Capital losses aren't fun, but they can help at tax time. You can use them to cancel out your gains. So if you had $1,000 in gains and $300 in losses, you'd only be taxed on $700. If your losses are bigger than your gains, you can deduct up to $3,000 per year from your regular income. If you have more, you can carry the rest forward to future years. 4. Capital gains tax rates in 2025. In 2025, long-term capital gains are taxed at 0%, 15%, or 20%, depending on your income level. Most Americans fall into the 15% bracket. If you make under around $47,000, single, or $94,000, married, you may pay 0% on long-term gains. If you earn more than that but stay under around $518,000, it's 15%. Over that, you'll pay 20%. Short-term gains are taxed at your ordinary income tax rate, which could be as high as 37%. This is why holding investments longer usually saves you money. 5. Selling real estate and paying capital gains. If you sell a home or other real estate for more than you paid, you might owe capital gains tax, but there are special rules for your primary residence. If you lived in a home for at least 2 of the last 5 years, you may be able to exclude up to $250,000 of gain if single or $500,000 if married. Rental properties and second homes don't qualify for this exemption. In those cases, capital gains tax rules apply just like they do for other investments, but depreciation and other factors also come in. 6. Reporting capital gains on your tax return. When you sell an asset, your brokerage or platform will usually send you a Form 1099-B showing how much you earned. You'll use this info to fill out Schedule D on your tax return. You'll list each sale, showing what you paid, your cost basis, what you sold it for, and how long you held it. The IRS checks this to calculate your tax. It's important to keep good records of every investment purchase and sale. If your records are wrong or missing, you might overpay or get in trouble with the IRS. 7. How crypto and NFTs are taxed. Cryptocurrency and NFTs are considered property by the IRS, not cash. So when you sell them or trade them, they trigger capital gains taxes just like stocks do. For example, if you bought Bitcoin at $10,000 and sold it for $15,000, you'd owe tax on the $5,000 gain. Even trading one crypto for another, like BTC to ETH, is a taxable event. The same applies to NFTs. If you create or trade NFTs and sell them at a profit, those earnings are also taxable. Keeping track of these digital transactions is very important. 8. Capital gains tax for inherited assets. When you inherit property or investments, you usually get something called a step-up in basis. This means the value of the asset resets to its value on the day the previous owner died. For example, if your parent bought stock for $1,000 and it's worth $10,000 when they pass away, your new cost basis is $10,000. If you sell it at that price, you owe no tax. This rule helps many heirs avoid big tax bills. But it's different from gifting assets, which can cause the receiver to take on the original cost basis instead. 9. Ways to reduce or avoid capital gains tax. There are legal ways to reduce or even avoid paying capital gains tax. One way is to hold your investments for over a year, which qualifies you for lower long-term rates. You can also use tax loss harvesting, which means selling investments that lost value to cancel out gains. This lowers your taxable income. Another way is to invest through retirement accounts like IRAs or 400 in ONEX. Inside these accounts, your gains grow tax-free or tax-deferred, depending on the account type. That means you don't pay capital gains tax when you buy and sell inside them. 10. When to pay and common mistakes. You pay capital gains tax when you file your taxes, usually by April 15 of the following year. If you make a lot from selling investments, you might also owe estimated taxes during the year. A common mistake is forgetting that even small trades, like in crypto or stocks, can count as taxable events. Another is misreporting the cost basis. Always double-check it. Also, don't forget state taxes. Some states, like California, tax capital gains as regular income. Knowing both federal and state rules will help you avoid penalties and file correctly. Capital gains tax may sound complicated, but once you understand the basics, it becomes much easier to handle. Whether you're selling stocks, real estate, or crypto, knowing when and how gains are taxed helps you plan ahead and avoid surprises. Long-term investments are usually taxed less than short-term ones, and there are many ways to reduce what you owe legally. Always keep records of your trades and talk to a tax professional if you're unsure. The more informed you are, the smarter financial choices you can make. Understanding capital gains tax is an important step toward growing and protecting your wealth. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.